In the aftermath of the economic crisis, many governments are calling for tighter banking regulations to keep such a debacle from ever happening again. But one INSEAD professor says that perhaps better bank governance may actually be a more effective answer to the problem. Harald Hau, professor or assistant professor of finance here at INSEAD, thanks for being with us on INSEAD Knowledge.
Thank you very much.
Why does bank governance actually matter?
Well, let me approach this question from a slightly broader perspective. There's a generally misconception about this crisis that it was essentially a crisis of financial markets. And this is, I think, not true if you look at what happened in more detail. While this was certainly a crisis about the financial system, the real failings of this financial crisis are located in banks. So I think a more analytical view of this, what happened over the last 2 years, reveals that it is really about banking failure. The failure of risk management, excessive leverage, these are the key problems related to this crisis, and not failures related to the financial market.
Now, you just completed a fairly comprehensive research study on bank governance and the competence of boards.
Yeah, so given that this financial crisis is essentially a banking crisis, it seems natural to look at the differential performance of different banks. Which are the banks that did well, relatively well in this crisis, and which are the banks that failed most? So that is sort of the background against which our study occurred. And here, together with a colleague at the University of Dresden, Marcel Thum, we looked closer at the performance of all German banks. And let me briefly explain why Germany is an interesting...
Why Germany, yeah.
In fact, Germany is interesting to look at because we have a banking system that has basically two different, relatively different and separate corporate governance structures. We have a large sector of banks that act just like private banks commercially, but that have a governance that is entirely, dominated by state ownership. And then we have a separate sector about as large of commercial private banks with private shareholders. But there, of course, the board representation is very, very different.
I would imagine that the state-owned banks have boards that perhaps are political appointees, not necessarily with a background in finance or banking, or am I wrong?
That is exactly what we find. So what we do in our study, we look at each single board member in roughly 30 German banks, half of them private, the other half publicly owned, and examine the career and the history of every single board member, which is going through about 600 resumes. We looked at educational level. There the difference is less pronounced. We looked at general management experience of board members, and we looked also at financial experience.
And what was that actually in the private banks?
And we find, of course, as you might have expected, that a lot of board representatives in the publicly owned banks, the so-called Landesbanken, were more or less politically appointed members. So those are people that typically lack any financial background, certainly typically don't have any banking experience. Here, the average financial competence measured by an index is about 3 times as high in the privately owned banks compared to the publicly owned banks.
So what did this mean to the bottom line, particularly during the crisis? Did the state-owned banks lose more because of lack of financial competence?
Roughly speaking, the average loss of banks during the crisis was about 3 times as high for the publicly owned banks compared to the privately owned banks. Even within the set of private banks, we find that private banks with more competent boards did on average better. So the crisis in a way is a failure of boards to implement decent risk management, but it's also a failure of the supervisory institutions. So that's sort of a consensus view right now, that the bank supervisors failed to perceive these risks. But you have to understand that the situation of a supervisory agency and the supervisory authority of the board is very much confronted with the same problems of very, very imperfect information. If you're an outsider, either as a regulator or as a board member, it's very hard to understand what is really going on within a large institution. So I think the working on both levels, improving bank regulation and improving board competence, I think are in a way complementary, and both need to be pursued.
If governance is tightened, would that sort of mitigate the need for more regulation, or is there a balance here?
I think there's new regulation put in place in Germany which introduces the notion of qualification being important, and board members can be revoked if judged or deemed incompetent. But I think on the private side, the initiative really has to come from the companies itself, from the shareholders, to press for better boards. So I think this is going to be, I think, one of the big building sites of for the capitalist system or the market-based system of this new century, to build better boards and better corporate governance. The potential there is very large. The potential for better regulation, one can be skeptical given our experience. We have 50 years or more of experience with bank regulation, and the crisis is kind of a reminder of the limitations of this regulatory route. I think a second and potentially more promising avenue for creating better financial institutions is to work on the corporate governance. And I think here an institution like INSEAD can make a very important contribution. INSEAD is just launching a new program, a director initiative, where directors, board members, are trained in a specialized program which is destined to improve corporate governance. And that is a way how INSEAD wants to draw the lessons of this crisis and improve management practice.
Thank you very much, Harald Hau, for being with us on INSEAD Knowledge.
Thank you very much.